We begin with new economic data that shows Canada's economy shrunk in the second quarter of this year. It's a fresh piece of information that the Bank of Canada will consider when deciding whether or not to hike interest rates again on Wednesday. And to many economists, it comes as a bit of a surprise. CBC's Jeannie Lee is following the story for us from Toronto.
Well, the Canadian economy wasn't expected to take a stumble backward. In fact, economists were expecting a little bit of growth. Instead, the GDP shrank at an annualized rate of 0.2%. And here is why there was so little spring in the spring quarter. There was a drop in consumer spending, definitely flattening out. And in fact, in the first quarter, consumer spending seemed to be so strong that that might have pushed the Bank of Canada to raise interest rates in June and July. Well, it turns out those numbers were overly stated. Now, housing activity sank for the fifth straight month in a row, and this was after those two summertime rate hikes. And this current quarter is also starting off pretty weak. Then you have the BC port strike and the wildfires, which should further pull down growth, meaning there would have to be a lot more growth to avoid a second quarter of contraction. Now, GDP is a fresh and key piece of the puzzle when the Bank of Canada next meets to consider interest rate moves, if any. That'll be on Wednesday of next week. And as it is, we are looking at a picture that one economist called shockingly weak. Here's what he meant. The jobless rate has jumped to 5.5% after falling steadily and then holding at about 5% for a good long time. Consumer spending, as I said, has flattened out. In fact, doesn't even keep up with population growth. And exports are down, with the U.S. having to revise its GDP downward as well. So these are early days when it comes to the full impact of the interest rate hikes that we've had to filter through to the economy. It usually takes up to 18 months. So more weakening may be ahead. Have a listen to this economist.
What we're looking at right now in the data that we just got from Statistics Canada is the full impact of those very first rate hikes that we saw back in March of 2022. So we have not yet felt the brunt of all of the interest rate hikes that have followed up until July. So there's a lot more to come.
And if that means more pain for the economy and for the job market and too much damage, while inflation continues to cool off, generally speaking, well, the bank's next move might be to lower interest rates rather than hiking them.
CBC's Jeannie Lee in Toronto. For more on this, we've reached Moshe Lander. He is in Montreal, and he's a senior lecturer of economics at Concordia University. Moshe, what do today's numbers mean for our economy?
I don't know that I'd go so far as to say that it's shockingly weak. That's really strong. It's a sign that, yeah, the economy is cooling off. The recession that we've been talking about for over a year might be finally upon us. And so this is a chance then for the economy to rebalance itself and right itself so that when it comes out on the other side, it's going to be a lot stronger than maybe it is going into the recession.
Is that why you say that what happened today is a good thing?
Yeah, I mean, I'm not going to go out and party this weekend because GDP shrank, right? But yeah, this is what we've been expecting. And, you know, when you have uncertainty and when you have people constantly talking about, are we in a recession? Are we in a recession? That itself creates anxiety. And so where businesses are reacting very quickly to interest rate hikes, consumers were very slow to respond because they didn't really feel the full impact of that. And so this is a chance then for consumers as well to try and figure out how they're going to manage that pile of debt that they've been accumulating for decades. And so again, here's a chance to right the ship. So maybe not celebration, but yeah, I'm certainly comfortable that finally the data is suggesting things are weakening.
We're looking at some Malvis here, so let's talk about these consumers you're mentioning. We heard some of the driving factors include a drop in consumer spending and low housing activity. So what does that tell us about consumer behavior?
Well, apparently, after all, they do respond to interest rate increases. I was starting to question that logic there because after all of those increases over 20 months, they kept showing resilience. And that was the phrase that we were using. So now The fact that maybe they're saying, wait a second, this is starting to hurt a little bit. We do need to save more. We do need to spend less, means that this is validation for the Bank of Canada. What they were doing all along was the right thing, and those that were questioning the Bank of Canada can now maybe realize that they maybe know what they're up to.
Let's talk about jobs. How does the job market factor into all of this, Moshe?
Well, you know, in Jeannie's comments there, she was talking about the idea that someone was saying that unemployment had jumped. You know, how many Canadians would be thrilled that our unemployment rate is only 5.5%? If you're of a certain age, the idea of 8, 9, 10% unemployment is a pretty standard ordeal here. So the fact that it's only gone up to 5.5% shows the sign that we're able to absorb a lot of people into our economy in a very quick amount of time, and it's not showing up in big jumping in unemployment numbers. We'll get a little more data in the coming weeks, but generally speaking, we've done a very good job integrating everybody into the economy. I'm quite content with 5.5% unemployment.
Let's talk about that big I word, inflation. We're seeing gas prices going up again. So where are we at in the fight against inflation?
You know, when the Bank of Canada sent out the last number, it was a little bit higher than people were expecting, and they said it's the last 1.5% that's going to be the real hard part to squeeze out, especially if people are getting used to inflation being around. And so it took a long time to stamp it out in the 90s. It's going to take a little bit of time here to stamp out that last little bit. As long as it's not going back above 4%, the Bank of Canada might be able to sit on interest rates at their meeting next week, and we might only have to worry about what the new data says when they meet at Thanksgiving.
See, you're reading my mind, Moshe. That's my next question. The Bank of Canada's interest rate decision set for next Wednesday, as you just mentioned. Will today's numbers mean no hike to the interest rates? Because that's what everybody's worried about.
I would say it shouldn't lead to a hike, but I don't get to make that final decision. But if somebody wants to make me the new governor of the Bank of Canada, I would keep interest rates on hold next week, because I just don't think that there's enough data there that suggests that an interest rate hike would be good for Canada at this point. Certainly not good for Canadians with lots of debt.
Your expertise are always on point. Moshe Lander is a senior lecturer of economics at Concordia University. Appreciate your insights as always, sir. Thank you, Moshe.
Anytime.